are back once again with another episode of Mission Control, the Bellwether Enterprise Podcast. We follow up a recently published episode with Lori Morfin by sticking around in Irvine, California, this time to talk with Executive Vice President Tom Kenny and Vice President Josh Boehling. The two of them highlight a few example deals and also the capabilities offered here at Bellwether Enterprise. They also discuss some of the processes they go through on deciding what the best option and what deal products are best for each individual client. Thank you all for listening to this conversation about equity deals with Tom Kenny and Josh Boehling. So yeah, we're up here in the new office, just moved down 5 floors here in Irvine, California. Josh, Tom, thanks for sitting down here and doing this podcast. And, wanted to mix it up a little bit because in the past we've done some different things. And one thing we haven't really gotten into on the podcast is talking about equity deals and kind of what all that means for, clients and from our perspective at Bellwether. So I want to jump into that a little bit. I guess either one of you wants to kind of take the lead on, all that's going on in that space here at Bellwether and kind of the opportunities that we provide to clients in that space.
Sure, I'll take that one. Bellwether, we pride ourselves on being involved in all phases of the capital stack. We've got a lot of clients that are developers that are also looking at acquisitions, and they are working to, complete the capital stack in all different ways. So on development deals, oftentimes we're looking at joint venture partners for them. We're looking to really find the most competitive cost of capital up and down the stack. So whether that's the construction loan or an acquisition loan, going to a certain leverage point and then bringing in a good long-term partner, or sometimes you do it with mezzanine funds. There's all sorts of ways to sort of skin that cat and get them the ammunition, the capital they need to complete or acquire their project.
Gotcha. And then anything to kind of add kind of from your perspective on, how you go about deciding kind of what's best for the client. There's all these different options and there's, different ways to kind of structure deals that works best for them. Kind of what are some strategies that you kind of use to break down like what's best for that individual client?
Sure. All good questions. And thanks for joining us here today. And really, as a trusted advisor, our focus is on building that stack. And it's going to be unique to that specific client. And it's going to be unique to that specific project as well, whether it's a ground up development, which we've worked on this year, to a repositioning of an existing product. So along the lines of that, you're going to have a different investment horizon. So there are a number of factors that come into play when we're trying to determine that optimal capitalization for that specific client or for that specific need. So there are a number of different avenues. Tom touched on a couple, whether we're going to a bank for financing and then combining that with pref equity, with a mezz piece, or with common equity. There are a number of different strategies that can be involved, and it's really up to us to lay out those options and provide feedback as to why and what we're recommending, and at that same time, allowing our customers to focus on their primary core business, which is getting those deals done, whether they're the developer and they're working on an existing project, looking to that next project, they know that they've got us in the background determining what that best capitalization is so they can continue to focus on their core business.
Yeah, Ryan, question number one we have usually for the client is this a long-term hold or is this a merchant build flip? Or if they're acquiring an existing property, we'll call it a value add deal, but again, looking to exit maybe 3 to 4 years rather than hold it, in their portfolio forever. And that really directs how you're going to sort of attack the case and go out and what kind of equity you're seeking.
Gotcha. Yeah, I know it's a much relationship business. So, being able to have the experience in the relationships with the clients, I know from your guys' perspective is critical. One thing you wanted to get into, obviously there's all the different kind of things you mentioned, the different options and opportunities. Maybe we can get into a couple examples of some deals that you've done, in this area or wherever on your perspective, just maybe some examples of some of these equity deals that we've been talking about that kind of summarize, give the big scope of things from what you guys have done and been able to do. Is there any break into an example or two of some of those deals that you want to talk about?
Sure. Josh, why don't you start with a couple of deals we've done recently over in the Las Vegas market for a good client where they were value add transactions. So they're going in and looking at an acquisition where they think they can enhance the value. And that's a little different strategy. So we had a couple closed recently in some apartments. Talk about those.
Yeah, we have a couple of success stories from earlier in the year. And I think you brought up a great term which is relationships. And that's really what we relied upon with these two transactions is long-standing relationships, both for providing the debt component and for providing the equity component. So in this case, after going to the market, what we ultimately determined was going from the equity perspective, going the private route, which was a longstanding client, a customer that Tom and I have worked with for how many years now, Tom? 20 years, a deep relationship, and very trusted relationship because of the term of the amount of time that we've been working with them. So it worked out really well. There was certainty of execution because this happened to be, or both these transactions were acquisitions. So we had a high level of comfort that our equity would show up with the check when it was time to close. And at the same time, we went to a relationship lender that we've worked with for a number of years, and they came in and provided a fantastic financing package. I mean, it was 80% of the acquisition price, and then on top of that, they were funding 100% of all the improvements that were going into this value add opportunity, or I should say into both of these value add opportunities. Separate transactions, but same players at the end of the day as far as who we used as a lender and who we used for equity, and both closed incredibly smoothly, and we've got a happy customer.
I think those deals on the equity side, for the gentleman that came to us saying, I want to buy these properties and here's my business plan, he ended up putting in 3 or 4% of the total equity because he put about 10 to 15% of the equity requirement, which was only 20% if you do follow Josh's math. And so at the end of the day, was able to control and build his portfolio and execute his business plan with very little of his own capital.
And one more thing to add is that then enables them to move on to the next deal because they didn't have to come to the table with a significant capital investment on their own, that they then had dry powder, so to speak, to move on to that next opportunity.
Gotcha. Another question I kind of have, what would you say differentiates what we were able to do here from some of the competitors or some of the other things that are out there that people can go towards from your perspective? Obviously you mentioned some of the things that we do well and are unique, but kind of what do you think separates and differentiates Bellwether from others?
The trust. I mean, you're dealing with generally very high deposits on these things. Somebody's going into it having a lot of trust that you're going to execute the business plan. They've got non-refundable money up, et cetera. So in the beginning, you've got to really understand what's their business plan, making sure we're going to the right people, that we can figure out the capital stack properly and everybody can fit in. And then these had to close in 60 days. So we ended up on these two transactions with a borrower that never closed with the senior lender before and never closed with the equity partner before. We'd closed with both. So there's a lot of trust, and we recognize that, and we take that very seriously because there's real money at risk for our clients, and we don't want to let them down. So the other deals that we can maybe touch on are ground up construction deals. We just completed a couple of spec industrial projects, or capitalized them. One was a brand new deal that again had to close pretty quickly. It's about a 400,000 square feet multi-building industrial development out in the Inland Empire. And our guy really would like the opportunity to hold it long-term. We ended up with and he had to close on the land without permits, which that's not everybody's cup of tea. Most of these equity guys, when they go into a deal, they want to know, hey, this is shovel ready, permit ready. When I close, we can move ahead with the business plan. So there had to be a little bit of faith there that we had a very experienced borrower who had done other business in this area. And so they went in and closed on the land as a pure joint venture. Equity partner was a pension fund. And we're in the process of, once he gets his entitlements, we'll close on the construction loan. We did that, and we did another deal earlier this year, the two of us on a multifamily deal, which is a little bit different. The borrower was willing to put a little bit more cash in that one, and we solved that with a construction loan from a kind of major money center bank, but also came in with a debt fund or a hedge fund to do the equity in the form of preferred equity on that one. So not quite as high in the capital stack, but at the end of the day, we had about 7 or 8 kind of different options on which way to go, and some were different if they were thinking long term, and others were thinking short term because this developer was a little uncertain in the beginning, but at the end of the day, it's a 92 unit infill, Orange County, ground up multifamily development, and again, they were very pleased with the results. So a lot of fun, these deals, and I think it's just good business for us aside from our normal day-to-day refinancing and financing activities.
Yeah, it's a good example of all the different things you guys are able to do and work out different challenges and things like that. And lastly, as we kind of wrap up, just we can touch base on what's going on in the marketplace in all these different areas here. And obviously we're in California and western half of the United States. What's overall do you see like the outlook of what's going on right now, and kind of leading into the future of how things are shaping up? If there's any input or insight you can offer on that perspective.
I think it's an exciting time. It really is exciting from the standpoint of tons of capital available, tons of liquidity in the market. And I think with these examples, just showing the diversification in it, whether we are looking to a bank, to private equity, to a pension fund, to institutional type investment, that it's plentiful. And at the end of the day, we still have all of our core product lines, our longstanding life insurance company relationships who have very strong allocations from 2019 that we've been successful in putting to work. And we think that all that is going to be available again in 2020. And then the agencies are keeping us plenty busy as well.
Gotcha. All right. Well, again, thank you for sitting down with me. Appreciate it. Thanks for welcoming into the new office. It's great getting out here and sitting down with you. So thanks. We'll have to do it again soon.
Okay.
Thanks,
Ryan.
Appreciate it.